Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Joe Tigay, managing partner at Equity Armor Investments, for an update on Nasdaq-100 performance, volatility trends, and how investors can use EA vol in their portfolio. Joe, it's great to see you as always. Welcome back to Trade Talks. We have a couple things to work through this week because since we saw you 2 weeks ago, we're starting to see more chop come back into the market, particularly with the Nasdaq-100.
Yeah, we're seeing some intraday swings for sure. Pre-market, we're seeing some down days. We're seeing some recovery in the middle of the day. Really interesting to watch how this all plays out. Of course, 2 weeks ago, and even a month ago, I started talking about this 50-day moving average, how it was kind of a critical level, and it remains to be the case. Nasdaq's having trouble getting above its 50-day moving average, and kind of we're now in a consolidation area. Given the fact that 2020 was such a fantastic year, maybe it makes sense for the market to consolidate while we let the prices catch up to the earnings.
That's a great point that you make, Joe. And I know as we're talking about the Nasdaq-100, the 10 years constantly coming into the conversation, but let's talk about volatility trends specifically, move away from the 10-year. Is there anything that you're seeing in VOLQ that either indicates we have a little bit more chop or things might be, slowing down a bit as we get into the spring and summer months?
Yeah, volatility is coming in even with the chop in the Nasdaq. So we're seeing it on the lower end of the range. I wouldn't say we're at an all clear spot by any stretch of the imagination. Still above 20, still in that area where I would say to me, there still is some concern of potential gap or a risk event to the downside. So I'm not ready to say they're all clear, although it is a good sign to see a volatility coming in slightly.
And Joe, give us a brief refresh of EA vol, how it's performing, how investors are using this within their portfolios, because it seems to be the perfect product as there's more volatility within the market. You're playing the up and the downside of that.
Yeah, that's been really great for us. Of course, it is a hedge to owning the Nasdaq. Now we've all seen lately the Nasdaq has had trouble with these rising rates. Rates are going higher. Usually bonds are in a portfolio that's going to hedge equities. This is a different way to hedge equities. We have a volatility component that's going to be negatively correlated with the Nasdaq. Right now, we're seeing bonds positively correlated with the Nasdaq, not giving advisors protection to the downside when the market goes down. And in fact, it's kind of like a double risk position. So this is a position that is going to have lower volatility and get equity returns over the long haul.
That is really interesting when you think about it in that respect, because it's been quite some time since we've looked at the 10-year and the Nasdaq-100. They just seem, not a correlating asset at the end of the day, but because rates have been so low, because growth companies and tech companies have had the run that they have, all the attention is on there. Meanwhile, volatility is quietly performing for you.
Yeah, it's nice. It's a nice thing to have in our back pocket when the market's down, to have something that's higher. That's why the 60-40 before the past 3-4 years was such a great thing for advisors. They could at least have one thing up on that day. Right now, I think it's important for advisors to look at their portfolio and say, am I diversified in risk? Historically, bonds would be yes, but lately that's not been the case. And I don't think with rates so low, it's going to be the case for some time.
Great point. Thanks so much, Joe, for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.